Welcome back to Report of Silver, your trusted source for daily precious metals analysis, where we break down the biggest developments in gold and silver and explain what they mean for investors, stackers, and anyone trying to stay ahead of the market. Today's silver move was powerful. After suffering a sharp pullback recently, silver bounced back strongly, and at first glance that might look like just another normal recovery. But when we look deeper into the structure of today's move, something looks different. The same drivers are present that usually move silver higher, but the way silver is reacting this time is telling us an important story about what could happen next. So stay with me through this full report, because by the end of this analysis, you will understand why today's recovery may not simply be another bounce, but potentially the beginning of a very important shift in market behavior.
And before we begin, let me know in the comments. Do you think silver reclaims $80 first, or does it revisit $70 before moving higher again? Let's begin with what happened today. Silver was clearly the star performer in the metals complex. It outperformed gold, platinum, and palladium by a wide margin. That is important because when silver leads the metals higher, it usually tells us that risk appetite is returning to the market. Investors are willing to move toward the more volatile asset instead of hiding only in gold. By late trading, silver had climbed nearly 3%, adding more than $2 an ounce and pushing back toward the $76 level. At one point during the session, it even touched $76.74. That is a major recovery considering that only recently silver had fallen below the $74 area and triggered concerns that it might break lower toward the bottom of the current trading range. But despite this strong move, we need to stay grounded. Silver is still below an important resistance area. For months now, silver has largely traded inside a broad range between $70 and $80 an ounce. That range has become a battlefield. Every move toward $80 has attracted sellers, and every move near $70 has attracted buyers. Today's rebound moves silver away from danger, but it has not yet broken through resistance. That means this is not yet a confirmed breakout. It is a recovery, but we still need follow-through. Now, the obvious question is, what caused today's rally? The answer begins with the stock market. The broader equity market surged today, and silver responded immediately. The DJIA jumped more than 600 points and moved back above the psychologically important 50,000 level. That kind of strength creates a risk-on environment. In simple terms, when investors feel confident, they often buy assets like silver because silver behaves partly like a precious metal and partly like an industrial growth metal. That dual personality makes it very sensitive to changes in market mood. What makes this especially interesting is that silver reacted even more strongly than gold. Gold rose nicely, gaining over 1.4%, but silver doubled that performance. That tells us something important. When gold leads, markets are often fearful. When silver leads, markets often believe growth is returning. That is why today's move deserves attention. Another factor influencing today's recovery may be changes happening at the Federal Reserve. Investors are increasingly watching new leadership dynamics and speculating about whether liquidity support is quietly being introduced through back-end financial mechanisms such as repurchase agreements. For viewers unfamiliar with that term, a repurchase agreement, or repo, is basically a way for the central bank to inject short-term liquidity into the financial system. More liquidity often means more money-chasing assets, and that tends to support both stocks and precious metals. Some analysts believe that hidden liquidity support may be helping push markets higher right now. Others argue that if too much liquidity is withdrawn later, it could hurt markets. But for today, the market clearly interpreted the environment as bullish. Stocks climbed and silver followed aggressively. This is what makes today different from previous silver rallies. In past cycles, silver often rose mainly because of fear. banking stress, inflation panic, or geopolitical tension. This time, silver appears to be rising because markets are regaining confidence. That changes the psychology completely. Instead of defensive buying, we may be seeing speculative buying return. That can create much faster price movements, but it also means volatility becomes much more dangerous. That is why I continue to emphasize range awareness. Silver remains trapped inside a wide but tradable zone. Investors who understand this can use volatility to their advantage. When silver gets hit hard, opportunity appears. When silver spikes quickly, patience becomes more valuable than emotion. Today was a strong day for silver, but the bigger story is not simply that silver recovered. The bigger story is that silver recovered differently, and that could matter much more in the days ahead. As we move deeper into today's market action, we need to look beyond silver itself and examine the macro forces that helped create this recovery. Silver never moves in isolation. It reacts to a network of markets, bond yields, the US dollar, crude oil, equities, and geopolitics. And today all of those moving parts created a much more supportive supportive environment than what we saw during the recent sell-off. That is why silver bounced so sharply. But understanding whether this move can continue depends on understanding what changed underneath the surface. Let's begin with interest rates. One of the biggest pressures on gold and silver over the last several sessions has been rising treasury yields. When yields move higher, non-yielding assets like precious metals often struggle because investors can suddenly earn better returns from bonds. That makes metals relatively less attractive. Earlier this week, that exact pressure was visible. Yields pushed toward levels we have not seen in a long time, creating a rate shock across financial markets. Silver was hit hard because it tends to exaggerate market moves compared with gold. But today, that pressure eased. The 10-year US 10Y slipped back toward 4.64%, and the 30-year yield also pulled away from recent highs. Even though the drop was not massive, it was enough to calm markets. That small cooling in yields gave precious metals breathing room. Gold used that breathing room to defend the $4,500 level, while silver used it to launch a stronger rebound from below $74. Now let's talk about the US dollar, because that also mattered today. The DXY weakened slightly, falling toward the 99 level. That may sound minor, but even small dollar moves can matter greatly for metals, since gold and silver are priced globally in dollars. A weaker dollar makes them cheaper for international buyers, which can increase demand. Today's softer dollar added another layer of support beneath the metals market. But the most important short-term driver may have been oil. This is where the story gets very interesting. Crude oil fell sharply today, dropping back below the critical $100 per barrel level. That is a major development because high oil prices create inflation fears. When inflation fears rise, bond yields often rise too, because investors demand higher returns to compensate for future inflation. And when yields rise, precious metals often face pressure. So when oil dropped today, the market immediately began to price in less inflation risk. That helped Treasury yields ease. Once yields eased, pressure on silver faded, then silver bounced. This chain reaction is critical to understand. Oil moved lower, yields softened, and silver responded upward. This is why I keep saying silver's story right now is not just about silver. It is about the broader macro machine. If oil stays below $100, it could continue helping silver stabilize. If oil suddenly jumps back to $104 or $105, that could reverse the entire picture very quickly. And what has been driving oil? That takes us directly into geopolitics. The biggest global concern remains the Strait of Hormuz. This narrow waterway is one of the most important energy corridors in the world. A huge percentage of global oil shipments pass through it. Any threat there immediately impacts crude prices, shipping insurance, inflation expectations, and ultimately precious metals. Over the last several weeks, tensions involving Iran, the United States, and Israel have kept markets nervous. Earlier, traders priced in the possibility of prolonged disruption, which pushed oil above $100 and helped create fear-driven buying in gold. But today, some of that immediate fear premium faded. Markets began to believe that either diplomacy or military stabilization could reduce the risk of a prolonged supply disruption. That reduced fear caused oil to fall, and ironically helped silver rise. This is one of the major differences between gold and silver. Gold often rises when fear rises. Silver can rise too, but it also benefits when fear starts to fade and growth expectations improve. That is exactly what happened today. Silver was not just reacting to fear, it was reacting to reduced fear. That is a very different kind of bullish signal. This is why I believe today's move deserves close attention. Silver did not simply recover because traders bought a dip. It recovered because multiple pressure points suddenly turned favorable at the same time. Lower yields, a softer dollar, lower oil, stronger stocks, and reduced geopolitical stress. That combination is powerful. The question now is whether it lasts. If these macro tailwinds continue, silver could challenge the upper half of its $70 to $80 trading range again very quickly. But if even one of these variables reverses, especially oil, the market could become unstable again just as fast. That is why this remains a trader's market, and why discipline matters more now than ever. Now let's focus on what silver itself is telling us through its price behavior, because this is where experienced market watchers start to see the difference between a normal bounce and a potentially meaningful market signal. Price is not just a number. Price reflects psychology. It reflects fear, confidence, positioning, and expectations. And today, silver's behavior revealed something very important. Buyers are still extremely active every time silver gets pushed into the lower part of this range. Over the last several months, silver has repeatedly traded between $70 and $80 an ounce. That range has become the dominant technical structure of this market. Think of it as a battlefield. Around $70, physical buyers, long-term stackers, and value investors become aggressive. Around $80, short-term traders often begin taking profits, and institutional sellers tend to appear. This creates repeated swings. That is exactly what we have been watching. But what makes today interesting is how quickly silver snapped back after breaking below $74. Normally, when a metal breaks an important support level, traders expect follow-through to the downside. Momentum sellers usually jump in. Stop-loss orders trigger. Fear increases. That often creates a second wave lower, but that did not happen this time. Instead, silver recovered quickly and strongly. That tells us there is hidden demand underneath this market. Someone, or many buyers, are stepping in aggressively on weakness. That is often what happens before larger upside moves begin. It does not guarantee a breakout, but it shows strong support exists beneath the market. Silver's volatility is another key factor here. We saw silver move nearly 3% in one day. For many assets, that is huge. For silver, it is normal. But that is exactly why silver attracts both opportunity and risk. This metal regularly exaggerates moves. If gold rises 1%, silver might rise 2% or 3%. If gold falls 1%, silver can easily fall 3% or more. That is why silver rewards patience but punishes emotion. Today's rally reminded everyone of that. Investors who bought the recent dip were rewarded almost immediately. Investors who panic sold near the lows probably regret it already. This is why I often tell viewers silver is not an easy market. It is an emotional market. It forces discipline. If you are chasing green candles, silver can hurt you. If you are buying carefully during fear, silver can reward you. Now let's compare today's move with previous cycles. In earlier rallies, silver often surged because markets were afraid. Bank stress, inflation fear, or geopolitical escalation. Those were defensive rallies. Investors moved into metals because they wanted protection. But today's move looks more like a confidence rally. Stocks were up, risk appetite returned, oil cooled, fear declined, yet silver still surged. That is unusual and bullish. Why? Because it suggests silver may be regaining its industrial growth identity. Remember, silver is not just a precious metal. It is heavily used in solar panels, electronics, electric vehicles, medical technology, and industrial manufacturing. When markets believe economic activity can improve, silver often gets an extra boost because investors price in stronger industrial demand. That dual identity, safe haven plus industrial metal, is what makes silver unique. And right now, both sides of that identity are helping. On one side, geopolitical uncertainty still supports safe haven demand. On the other side, stronger stock markets and reduced rate pressure support growth expectations. Silver is benefiting from both. That is a very powerful combination. But this is where we need caution. Silver is still below the upper edge of its range. Until it breaks decisively above $80, we are still in a range trading environment. Many investors make the mistake of treating every rally as a breakout. That can be dangerous. A true breakout usually requires multiple confirmations, strong volume, consecutive closes above resistance, and continued macro support. We do not have that yet. What we do have is a reminder that silver remains highly resilient. Every time the market tries to break it lower, buyers show up. That should give long-term holders confidence. It suggests that underlying demand, especially physical demand, remains very strong. And that matters because physical demand often leads paper price eventually. For stackers, this reinforces a familiar strategy. Volatility is your friend if you know how to use it. Buying during panic often works better than buying during excitement. Today's move proves that again. For traders, this means flexibility is critical. This market can swing hard in either direction. The winners are usually those who stay patient, respect the range, and avoid emotional decisions. Silver's message today is simple but powerful. This market is not weak. It may be volatile, but it is not weak, and that distinction could define what happens next. Now let's talk about what could happen next, because this is where strategy becomes more important than emotion. Today's recovery was strong, but what silver does over the next several sessions will tell us whether this was simply a relief bounce or the start of a larger move back toward the top of the range. This is where investors need to stop reacting emotionally to daily headlines and instead focus on the signals that matter most. The first signal to watch is oil. Right now, crude oil remains one of the most important external drivers of silver price action. Today, oil falling back below $100 per barrel helped calm inflation fears and ease pressure on Treasury yields. That directly supported silver. But oil is still highly unstable because the underlying geopolitical problem has not fully disappeared. The risk centered around the Strait of Hormuz remains unresolved. If shipping flows normalize and tensions cool further, oil could continue falling, which would likely support silver and gold through lower yields and less market stress. However, if there is another military event or another disruption in shipping, oil could jump back above $100 very quickly. If that happens, inflation concerns could immediately return. Treasury yields could rise again, and silver could get hit just as fast as it recovered today. That is why I believe oil remains the single most important short-term variable in this market. The second signal to watch is bond yields. Keep your eyes on the US 10Y and longer duration treasury markets. If yields continue easing, that creates a more supportive environment for precious metals. But if yields return to recent highs, metals could face renewed selling pressure. This matters especially for silver, because silver's volatility amplifies these moves. The third signal is the US dollar. The DXY weakened slightly today, and that helped. If the dollar continues drifting lower, it could provide another tailwind. But if the dollar strengthens again, that could limit silver's upside. Remember, silver rarely moves based on one factor alone. It reacts to combinations of pressure. Now let's talk about the technical setup. Silver remains inside that broad $70 to $80 range that has defined the market for months. That range is becoming more important, not less. The longer a market trades inside a range, the more meaningful the eventual breakout becomes. Every test of support and resistance builds pressure, like a spring being compressed. Right now, support near $70 has held repeatedly. That tells us buyers are committed there. Resistance near $80 has also held repeatedly. That tells us sellers remain active there. Eventually, one side will lose. When that happens, the move could be powerful. If silver breaks above $80 and holds it, the next targets could come quickly. First $85, then potentially $90. And remember, silver was near $90 not long ago. That means the market already knows those prices are possible. That matters psychologically. On the downside, if silver unexpectedly breaks below $70, sentiment could turn sharply negative. That would likely trigger stop-loss selling and open the door to a much deeper correction. Right now, that is not the higher probability outcome, but it must remain part of the risk framework. This is why I continue to describe this as a trader's market and a stacker's opportunity. Traders can use the volatility inside the range. Long-term holders can use the dips to build positions slowly through dollar-cost averaging. But chasing price after a big green day like today usually carries more risk than reward. Personally, if I were looking to add silver, I would prefer patience. Let the market come to you. Silver has repeatedly shown us that emotional buyers often overpay, while disciplined buyers usually get another chance. And that brings us to the most important mindset right now: agility. Markets are moving fast. Headlines are moving faster. Political statements change by the hour. One comment from policymakers, one military update, one surprise inflation number, and the entire market can reprice in minutes. That means rigid thinking can be dangerous. You need a plan, but you also need flexibility. If silver pushes toward $80, watch how it behaves there. Does volume increase? Do buyers stay aggressive? If silver falls back toward $72 or $73, watch whether physical demand returns immediately. Those reactions matter more than opinions. Today, silver reminded us that it can recover very quickly, but whether that recovery becomes something larger depends on what the next few days confirm. This is not the time to guess. This is the time to observe, stay disciplined, and let the market reveal its next move. As we close today's market report, I think the most important takeaway is this: silver is still doing what silver does best. It is forcing investors to stay humble. This metal never moves in a straight line. It never rewards emotional decision-making for very long. It creates excitement on the upside, fear on the downside, and confusion in between. But if you learn how to read it, silver often tells you much more about the broader market than people realize. Today's move was a perfect example of that. On the surface, it looked like a simple recovery day. Silver fell hard recently, then bounced back strongly. That happens all the time. But when we looked deeper, we saw something more important. We saw a market that is still highly supported. We saw buyers step in quickly when prices moved lower. We saw silver outperform not just gold, but the entire precious metals complex. And we saw it happen during a session where broader market confidence returned. That matters. It tells us that silver is not behaving like a weak market trying to survive. It is behaving like a strong market trying to decide when it wants to move higher again. Now, that does not mean silver is about to explode tomorrow. We have to stay realistic. The $70 to $80 trading range is still intact. Until silver breaks clearly above $80, we are still in a sideways environment. That means patience remains essential. Some days will look exciting. Some days will look discouraging. But unless the range breaks, those moves are part of the same bigger story. And honestly, that is not a bad thing. For long-term investors and physical stackers, ranges can be a gift. They create repeated opportunities. They allow you to buy during weakness instead of chasing strength. They allow disciplined accumulation. Many experienced silver investors actually prefer this kind of environment because it rewards patience. For short-term traders, this range creates opportunity too, but only if risk is managed carefully. Silver's volatility can be your friend, but it can also become your enemy very quickly. A 3% up day can become a 3% down day just as fast. That is why position sizing, timing, and emotional control matter so much. Looking ahead, I believe the next several days will revolve around a few key themes. First, oil. If crude remains below $100, that should continue easing pressure on precious metals through lower inflation fears and softer yields. Second, bond yields. If the US 10Y keeps falling, that gives silver more room to breathe. Third, geopolitics. The Strait of Hormuz situation is still the wild card. Any new disruption there could instantly change everything. And finally, investor psychology. That may be the biggest factor of all. Markets right now are highly emotional. Traders are reacting to every headline, every policy statement, every rumor. That creates volatility, but it also creates opportunity for those willing to stay calm while others panic. That has always been one of the biggest lessons in silver investing. Do not let the market control your emotions. Let your strategy control your actions. If your strategy is long-term wealth preservation, then today's volatility should not scare you. If anything, it should remind you why physical silver remains such an important asset class. It is scarce, it has industrial demand, it has monetary history, and it remains one of the few markets where sentiment can change dramatically in a matter of hours. That is why we watch it so closely here on Report of Silver. And before I finish, I want to sincerely thank every one of you who watches these reports. Whether you are here daily, weekly, or just checking in occasionally, your support means more than you know. This channel continues growing because of this community, and I truly appreciate that. If you find value in these daily reports, please share them with others, leave a comment, and let me know what you are seeing in the market. So now I'll leave you with today's closing question. Do you believe silver stays trapped in this $70 to $80 range a little longer, or do you think the next major breakout is closer than most people expect? Drop your thoughts below. I read your comments, and I always enjoy hearing your perspective. Thank you for watching Report of Silver. Until next time, stay informed, stay disciplined, and keep watching the silver market closely, because this story is far from over.